In this video, I will be introducing consolidation after acquisition, focusing on the first year after acquisition when the parent company uses the equity method to account for their investment. Up until now, we have dealt with the date only with the date of acquisition. On the parent general ledger, we recorded our initial investment in S at cost. On the worksheet, we eliminated that initial investment in S against the subsidiary equity accounts and eliminated any intercompany transactions. We've also only dealt with the balance sheet. Anyone know why that is? Very good, girls. The balance sheet is for one point in time, and so far we've only concerned ourselves with the date of acquisition, or the day that we gain control of the subsidiary. Now we have to consider what happens as time passes and we continue to operate as a consolidated entity. During the course of the year, the parent company will account for its investment using the cost or equity method. So remember when I said you'd have to remember some things from the investments chapter? This is why. When we get to our next financial reporting date, the eliminating entries needed will depend upon the method of accounting for investments used by the parent company. In the investments chapter, we said it didn't matter if a company used the cost method or the equity method because either way they would end up having to consolidate their financial statements. Using the cost versus equity method will result in different amounts on the parent general ledger, but the consolidated financial statements should be identical regardless of the parent's accounting choice. Throughout the year, the parent company will record changes in the value of their investment depending on the method of accounting selected. If the parent company chooses to use the cost method, then the investment in S account will decrease when the subsidiary pays liquidating dividends, but otherwise will remain at original cost. If the parent company chooses to use the equity method, then the investment in S account will be decreased anytime the subsidiary pays dividends and will also be adjusted for the parent's share of any income or loss reported by the subsidiary. Note, your book makes the distinction between the complete equity method and the partial equity method. Whether or not the partial equity method is truly allowed under US GAAP is debatable, and it adds extra complexity to the situation. So we will cover only the complete equity method in this class. Okay, so since the acquisition date, the parent company has adjusted their investment in S according to the rules of either cost or equity method. When we get to our first year end as a consolidated entity, we have some extra work to do. On our worksheet, we still need to eliminate our initial investment in S and any intercompany transactions. But now we will also need to eliminate any changes to the investment in S account made during the year. We will also now need to prepare a full set of financial statements. So in addition to the balance sheet, we will need an income statement, retained earnings statement, and a statement of cash flows. Our eliminating entries from now on will follow the same basic five steps. First, we will eliminate any intercompany transactions. Next, we will eliminate any current year income of the subsidiary recorded by the parent. This only applies to the equity method. However, for the cost method, we will substitute a very special entry, the entry to establish reciprocity, once we get to year 2 or beyond. For now, hold that thought. In step 3, we will eliminate any current year dividends paid to the parent by the subsidiary. Finally, steps 4 and 5 are the ones we've already been practicing, where we will eliminate the subsidiary equity accounts and allocate any difference between implied and book values. The only differences are that some of the numbers will change on us as time passes, and we will now need to specify a debit to the beginning balance of retained earnings rather than just saying retained earnings. The reason for this will hopefully become clearer when we get to the worksheet a few videos from now. Let's look at an example. In this example, we have PERT Company purchasing 85% of the outstanding common stock of Sales Company for $350,000 on January 1st of 2014. On that date, Sales Company's stockholders' equity consisted of common stock of $100,000, other contributed capital of $40,000, and retained earnings of $140,000. PERT Company paid more than the book value of net assets acquired because the recorded cost of Sales Company's land was significantly less than its fair value. During 2014, Sales Company earned $148,000 and declared and paid a $50,000 dividend. PERT Company uses the equity method to record its investment in Sales Company. So first thing they want us to do is prepare the investments related entries on PERT Company's books for 2014. But before we do that, I want to just take a minute to remember our computation and allocation of differences schedule, because They gave us all of this great information up here, which should just be screaming, we need to put together a computation and allocation of differences schedule. If you see your ownership percentage, the amount we paid, and equity amounts for our subsidiary, it's time to put together that schedule. So we know we're going to need it. We might as well do it right now. So remember, we're going to start with our ownership percentage, which in this case is 85%. That leaves 15% for our non-controlling interest. Those have to add up to 100. Our purchase price for this entity was $350,000. We're going to extrapolate that to estimate the value of the entity as a whole. So we're going to take the $350,000 and divide that by 85%. Now, this is just an estimate. If for some reason we have a better idea of the entity's value as a whole, or the value of the non-controlling shares, we should use that information. But in the absence of any other information, this is a decent way to estimate. Okay, then we're going to take our non-controlling shares and we're going to multiply their percentage times that total to estimate the value of their shares. So we get a total implied value of $411,765, and our non-controlling interest has a value of $61,765. So now we're going to compare our implied value to the book value of the subsidiary. So our subsidiary had common stock of $100,000 on the date of acquisition, other contributed capital of $40,000, and retained earnings of $140,000. We're going to add these guys up, and we get a book value of $280,000. So now we're going to compare our implied value, or the fair value of the entity as a whole, to the book value of that subsidiary entity. And we have a difference between implied and book of $131,765. So we were willing to pay more than book value by $131,000. So this could be for two reasons. It could be that the book value undervalues the net assets. So there's some fair values that are higher than what is recorded in the general ledger. Or there could be goodwill, or both. So in this case, again, we need more information. We come up here and it says PERT company paid more than book value because the land was was recorded at significantly less than its fair value. So what they're telling us is that this entire difference is due to land. So we're going to allocate our entire difference to land. Now remember, in this case, we're going to be writing up land. That's going to require a debit, and we're going to enter any debits as positive numbers. So we're just plugging it, but it's going to be a positive number. We're going to subtract it out, and this is just showing us that we've allocated our full difference, and our entries are going to balance when we go to do them later. So now we can get down to the task they've actually given us. So what they want us to do is they want us to take a step back from consolidation, a step back from our eliminating entries, and think about what the parent company is recording on their general ledger. And so for that, we're going to use these yellow entries, which are showing us that we are making these entries in the parent's general ledger. First thing is record the purchase of our investment in S. So just like in our investments chapter, we're going to create our asset. We're calling it investment in S now. And we know from our computation and allocation of differences schedule that we paid $350,000 for this. And most likely we paid with cash, unless they tell us otherwise. Then, because it's the equity method, so they don't tell us what entries we need to make. They're just saying, make whatever entries you need to make. So because it's the equity method, we also know that if our subsidiary reports income, we're going to need to increase our investment in S account. So they told us that sales company earned $148,000 of income. So that means that our investment is worth more now. So we're going to debit investment in S for $148,000 times our ownership percentage, which is 85%. So we're just going to increase our investment in S for our portion of the subsidiary's earnings. Now, our credit here, in our investments chapter, we called it investment income, and it still is investment income. But your book that we are talking about, or that we are using now, calls it equity in S income. So that's what I'm going to call it to keep you guys from getting confused when you're doing your homework. Under the equity method, we also make an adjustment to our investment in S whenever the subsidiary pays dividends. So the subsidiary paid some dividends. So what happens is we literally get a check in the mail. So we're going to increase our cash. And how much was that check for? Well, they paid $50,000 in dividends total. Of that $50,000, 85% would have come to us. The remaining 15% would have gone to their non-controlling shareholders. And then again, because this is the equity method, we're going to decrease the value of our investment account. So we're treating our investment account as if it was a retained earnings account. It increases for positive income and decreases when dividends are paid. Okay, so for part 2, they want us to put together our eliminating entries for our first year end. So last time we were talking about our eliminating entries, we did them as of the date of acquisition. Now time has passed and we're at our first year end. So our computation and allocation of differences schedule is prepared on the date of acquisition and it doesn't change. Then on the date of acquisition, we also prepared our journal entry to record our investment. Then at the end of the year, we got word of how much income our subsidiary had made and we recorded that. And we received dividends and we recorded those on the parent's books. So now we're going to take our general ledger from our parent. We're going to add to that our general ledger from our subsidiary. And we're going to make some eliminating entries to make adjustments to that starting point. Okay, so our first, we're just going to follow our 5 steps here. So the first one is eliminate any intercompany transactions. Now in this case, they didn't tell us about any. We don't have to worry about that. And honestly, for most of the problems we do for the rest of this class, they won't have that mixed in because they're trying to teach us new things. But I want to keep reminding you that we need to keep an eye out for those. So that's always going to be step 1. Step 2 is to eliminate any subsidiary income recorded by the parent. So if we come back up here, that's talking about this entry right here. So during the year, we had investment income because our subsidiary made positive income. So we can't record income from our subsidiary because we're going to add our subsidiary's entire income statement onto our balance or onto our income statement. So we don't need this summary of our share. We're going to get their whole income statement added to ours. So we need to undo this. So that's on our general ledger as a credit. So we are going to debit it. Likewise, we want to get rid of our entire investment in S. And so the way we're going to do this is we're going to deal with everything that happened before this year in one entry, and then any adjustments we made to it this year in these 2 entries we're doing right now. So this change right here, we're just going to literally undo this particular general ledger entry that we had in B there for the purposes of financial reporting. So remember, this entry stays in our general ledger. We're not really undoing it. We're just undoing it on the face of our financial statements. Okay, for step number 3, we need to eliminate any dividends that the subsidiary paid to the parent. So in this case, we don't need to worry about the cash because that's the situation where we're taking cash out of one pocket and putting it in the other. Whether we add that cash to our consolidated balance sheet from the parent's general ledger or from the subsidiary's general ledger, it doesn't really matter. It's still our cash. We're not eliminating it. So we're going to leave that be, but we do need to get rid of this investment in S. So we're going to debit investment in S. But that leaves us short a credit. So what are we going to do? Well, it turns out that this is a very special intercompany transaction. And for our intercompany transactions, we're going to be looking for something that is on our parent's books to cancel out against something that's on our subsidiary's books. And so in this case, we have something on our parent's books, investment in S, and we need to think about what's on our subsidiary's books. So when our subsidiary issued these dividends, they would have done dividends declared. And let's just say they paid them right away. Let's not go through any sort of delay. And they would have credited cash. So this is what our subsidiary would have done. And they did it for the full amount, which was $50,000. So again, we said we don't care about the cash, but that dividends declared, we do care about that because we can't declare dividends to ourselves. You couldn't ever pay dividends to yourself as just the parent company. So once we're consolidated and acting as one company, we have to get rid of that. So we are going to get rid of dividends declared from the subsidiary. But our amount is going to be the $42,500 because that's just the part that came to us. So the difference between this number and this number is going to be the amount that was paid to our non-controlling interest. And so that cash actually left this consolidated entity, and that actually was an arm's length transaction. And so that's fine. Those get to stay dividends declared. Okay, so this was the new part. And now we're up to the part that we know. So in this one, we're going to do the same steps that we did in our last video. First things first, we need to get rid of our investment in S. So investment in S was an asset. We want to get rid of it. We're going to credit it. And I'm going to go through and put all of our numbers first, or all of our accounts first, and then come back and fill in numbers. We also want to get rid of all of our subsidiary equity accounts. Again, looking at our computation and allocation of differences schedule, we see there are 3. They all have normal balances. So in order to get rid of those, we are going to debit common stock of our subsidiary, other contributed capital of our subsidiary, and remember, this is the part that's new. We're going to designate 1/1 or January 1st or whatever the first day of the fiscal year is, retained earnings of our subsidiary. Okay, so we get rid of our subsidiary equity, get rid of our asset account. Then we need to establish a non-controlling interest if we own less than 100%, which we do. So that is a new equity account. And then we're going to need any difference between implied and book. That difference between implied and book is positive when we get to the end of this first half of the schedule. So that indicates to us that that is going to be a debit in this entry. Okay, so a few things here. Our 1/1 retained earnings can't have changed during the year because 1/1 was our date of acquisition, right? So if we are going all the way back to the beginning of the year and eliminating whatever retained earnings was on the date, on the first day of the fiscal year, well, the first day of the fiscal year was our acquisition date. So this is still going to match our computation and allocation of differences schedule. Remember, this schedule is prepared as of the date of acquisition, but these accounts could change over time. Now, for the purposes of this class, common stock and other contributed capital will also stay the same over time. So our subsidiary won't issue any new shares during our consolidation periods. So those are always going to be the same just because our book is nice to us. So whatever they were on the date of acquisition, that's what they will still be when we add our subsidiary general ledger into our worksheet. All right, now investment in S. We know investment in S did change, right? Because we initially recorded it for $350,000, which is what's on our computation and allocation of differences schedule. But then we increased it by $125,800 and we decreased it by $42,500. However, we already eliminated this difference, right? So we already undid our increase and we already undid our decrease. So after doing that, what's left? Just our initial balance. So our investment in S is also still $350,000. Well, if all of those numbers are the same, then our non-controlling interest must also match the date of acquisition. And also our difference between implied and book is always $131,765 because that is calculated on the date of acquisition and it doesn't change. Okay, So then the only thing that's left to do is to allocate our difference between implied and book. So it was a debit, we're going to credit it. And we're going to use that to increase any assets or liabilities to their fair value. And once we've done that, anything left over will go to goodwill. In this case, they told us the entire difference is due to land and that we need to increase the value of land. So that makes sense. Land is an asset. Assets get bigger with a debit. So we're going to debit land for $131,765. This concludes our introduction to consolidation after acquisition with a focus on the equity method. Don't forget to email any questions for our discussion.